Everyone, thank you for attending. We are very, very lucky to have David King, one of ABQ ID and Activate's mentors for the last few years, and Zach Spangler, CEO and founder of Nimble Compensation. And Zach is a graduate of our accelerator and incubator programs. And they're going to take you through what is called unit economics. And the tagline here, learning the driving principle for a successful business. So they're going to try to take you into the depths of how you figure out what your business is worth and all reasons that you really want to know how to do that. We're going to have one exercise during the session and one opportunity to work in breakout rooms. You were all asked to produce 2 lists to bring to this session. One of them is a short list, 5 to 10 items of your monthly expenses, and let's say something of the same order for your yearly expenses. So if you haven't brought that with you, I'll just ask you to take a minute down and list those to the best of your ability. And I guess with that, we can get started. Again, as Dan said, watch the chat box. We'll be putting some things there, including links to documents and the survey. If you have questions, you're welcome to post those questions in the chat to everyone. Prefer to send them just to me, you can do that as well. And I'll find an opportune time to pause the presenters and get your questions answered. All right, well, let's get started. David?
All right. Thanks, everybody, for interrupting your pandemic moment to talk a little bit about unit economics. This is a topic I think it's really crucial to understanding and being successful in a startup. And often it kind of gets buried amongst all the millions and millions of things that you have to do as an entrepreneur to get your company up and running. I've been brought in by VC specifically to help a company understand kind of what a single transaction looks like. And it's really important, and it's not that difficult, but some people just don't naturally grasp it. So I think we're here today to try to help those that maybe struggle with this idea to understand it. So what is unit economics? It's basically taking your business and focusing on just a single transaction with a customer. And it really drives the rest of your business. And like I said, it can get lost in the shuffle when you're learning about legal and doing bookkeeping and finding customers and building your product, et cetera, et cetera, et cetera. This is one key concept that's often lost. So we wanted to highlight it today. I think it's also, if you're going to be operating under lean principles, this is a crucial piece of that. In lean methodology, you come up with theories about your business, and then you go out and test, right? And then you learn that you weren't quite there, and then you iterate and iterate. And this is a theory that has to be amongst all the other theories you have that you need to go test and make sure that you're building a profitable and viable business. And the other thing I'd say is when you focus on one single transaction, you can really get a better, you are put in a better place to think about pricing. So with that, let's go to the next slide, and I'll let Zach pick up from here. Zach, you still there?
I am, yeah. I don't see the slides moving. I don't know if that's just
all right.
me.
I've got 2, there we go. I've got 2 monitors and got clicking on the wrong one.
So, hey guys, I just want to reiterate kind of what David said. Thanks for joining us. My background before starting Nimble Compensation was in finance and accounting. And this is, as David said, unit economics in my mind is one of the most fundamental principles when it comes to building a business profitably. right? And so what unit economics really allows us to do is it allows us to boil our business down to a single transaction to really understand, are we making money? Are we not making money? And based on that, that allows us to kind of play and understand, okay, how can we work on building this business? So an example of that is, I was working with a company the other day, and basically they were trying to understand, can I afford to pay someone commissions? And so what we did is we broke down their business to the smallest level possible to understand how much money are you making per transaction and what can you afford to give to this person as part of a commission plan. And so by boiling down the business to this single transaction, it really gave a lot of clarity and insight in terms of what the business could afford. And as David said, even if their pricing was right. And so there was some really great insights that came out of as a result of that. And so why all the fuss here? And so one, profitability attracts investors and employees. And David is going to talk about this a little more, but especially with the pandemic going on, being profitable and future cash flow is really important to valuations. And so profitability is going to attract those investors and employees. If also, I think from my understanding, most everyone on this call is bootstrapped, meaning that you were building this business with your own money. And so as a bootstrap business, you want to get to being at a profitable point as quickly as possible, or else you're losing money. You have to go find a second job to help float this business. And so getting to profit is really critical, and unit economics helps us understand how to do that quickly. It also helps us communicate a kind of a value proposition. And like David said, in terms of understanding big picture and financial projections, unit economics is really critical because it allows us to then look at, okay, based on what I'm spending today, if I were to get 10 more customers, am I profitable at that point? And it really lets us play and understand, okay, how many customers do we need to be able to drive profitability? Again, helps make business decisions. And yeah, it does. I think the last point is really important, is it forces us to think deeply kind of about the value exchange with customers. David, do you want to touch on anything more on those points?
No, I was going to just drop in this next slide and talk about the numbers. So,
okay,
less words. Let's see if I can advance it. All right. Yeah, let's just look at some numbers. And this is just a generic company that's selling a product. And in this example, they sold one unit for $29.95. Now, there's a concept that you want to take expenses that are directly related to delivering that product or service and put it in a bucket of expenses called cost of goods sold. And another term for that would be cost of revenue. And so this is a key concept for people to understand, that you have, let's say you have the universe of expenses like rent and salaries, et cetera, et cetera. You need to separate those expenses that are directly related to delivering revenue, sales, all right? And often people ask, well, how do you know which costs should go there as opposed to going in the general expense bucket? And I think the best answer to that is to look at other companies in your industry and see what they're using. So usually industry segments will have common practices. And in this example, this is super common. If you're manufacturing and selling a product, then you want to put the cost of materials to build that product in this cost of goods bucket. You also want to put apportion labor on a per unit basis and allocate that in cost of goods. And then when you're selling, another example, you might pay your merchant bank 2 or 3% to build clear that through a Visa card. So you add up those costs that are directly tied to your building, delivering that one unit of sale and put it in cost of goods. So if you do the math, you add that up, you take $29.95 and you subtract all the costs related to delivering that, that was the total for $6.40. You have $23.55 at the end of the transaction that's yours to keep, right? That is what we call the contribution margin. So for each unit sold, you're collecting $29.95, but in reality, the cash that you get to keep at the end of the day is $23.55. And so what we wanted to do next is, and the other thing is that if you take that contribution margin and then divide it by the original sale, then you get a percentage, which we call gross margin. And when you're building a company, you want high gross margins, obviously, because that means you're generating more cash that can go towards paying all your expenses and growing the company. So if my numbers were instead $29.95 and the cost to deliver that sale was $25, then obviously you're not going to be clearing as much cash. And if you do the math on the percentage wise, it's going to be a lot lower gross margin. So that's an important number to understand about your business, especially when you want to compare yourself to other companies that are similar. And a high gross margin is one of the key criteria that investors will look at when they're thinking about investing in your company. So that's the basic math. And what we wanted to do now is say, let's apply that to, this is a very simple example. Let's say that our total budget for the entire year is going to be $100,000. And what I want to do here is not unlike creating a home budget. You know, you have, you've got your mortgage, you've got utilities, you have food and all those things. You can add up all those costs. And then you can kind of back into, well, how much money do I need to make in order for me to fund my lifestyle, right? This is kind of a similar example. So what we're doing here is say, okay, between staff and equipment, overhead, all these things for 1 year, I'm going to say, I've figured out it's going to cost me $100,000 for this first year of operations. And if we go back to that original slide, we do 1 unit of transaction and $23.55 is free and clear, available to go pay down that $100,000. We can divide the $100,000 by $23.55 and figure out how many units we're going to have to sell during this time frame to cover that budget. All
David?
right? Yeah.
Yeah, sorry for interrupting. So we have a question from chat regarding how to calculate cost of goods sold in a marketplace where it's not, things aren't being manufactured, you're not purchasing them, I assume, you know, through an established supply chain, etc. He's going out and he's finding this stuff in all sorts of places. And I guess it's hard to actually put numbers on some of those activities.
Yeah, I think the answer to that is I always think on averages. So let's say you get one supplier that costs $10, you get another supplier that costs $5, another that costs $7.50. I think what you want to do when you do this type of math is just say, on average, I blend all these rates together and say that's what my average cost for, you know, raw materials. You know, is that a reasonable answer to your question?
Chap, is that good? No. Can you unmute him, Dan?
Sure, I'm muting. Where is Mr. Chap at? There he is. Chap, you're unmuted.
Hey guys.
Hey, Chap.
No, so David, I really liked your answer. I just wanted to clarify. So like, we go to a bunch of events, we work with a bunch of mom and pop used gear stores. There's just these kind of number of different ways we're sourcing gear. Would you say like my best course of action is just to kind of say, look at the whole action and kind of put a number on it, not really worry about the separate pieces, saying putting this gear in my warehouse probably cost me about this much?
Yeah, I mean, it really, you gather all the data and come up with a reasonable average. of those costs. That's really a way to do it. You know, another example is labor.
Right.
How do you allocate those labor costs, which can be pretty significant, right? And so you need to, you know, maybe you have one person early on who is, they're doing administrative kind of things or sales kind of things, but then they're also in there doing packaging, right? Putting together kits that are ready to be shipped out. You know, you might come up with an informal way of splitting that time and say some of that is like a departmental expense, but this portion, maybe even half of their time, really ought to be allocated to cost of goods.
Sure. Okay. That makes sense. Thank you guys.
Sure.
Yeah, and I just to jump in on that, I think the one other piece is, if I understand what you're saying correctly, you're going out to all these different places and you're buying gear from someone, then marking it up and reselling it. Is that correct?
Pretty much.
So in that case, really, the largest portion of your cost of goods would be whatever you're paying those people to get their gear. That becomes your cost of goods. And then to David's point, also, if there's the labor, whoever's driving out to that mom and pops and buying and getting that, you'd probably want to allocate some of that labor into your cost of goods as well.
Sure.
But that's kind of the bucket that I would be considering cost of goods is the price you're purchasing that stuff for. And then, yeah.
But so then something like Carter, who's my chief technical officer working on my website, he's not falling into that bucket.
No, he's not.
Right. Okay.
Really?
Cool.
That would be what's called below the line. That's departmental expenses. So you have the revenue, and then you have the expenses just related to selling that product. And then below that, you have all the rest of the expenses. So
right.
That would fit all the rest of the expenses.
Okay. Thank you, guys.
Sure. All right. So we had the example of selling a product, but wonder if you're selling a subscription. And I'm looking up here because I have a second monitor. I'm not praying to the heavens to get the financial guys to come tell me the answers. But in this case, it's the same thing, 2355, but you have 12 of those transactions in 1 year. So it's not that much different, but you'd multiply that 2355 by 12 months, and then you divide the $100,000 budget by this new number, and this turns out to be 354 subscriptions in order to cover that $100,000 budget. So that's kind of in a nutshell. And again, we're looking at it from like an annual perspective here. And Zach's now going to kind of break it out and look at it from a monthly point of view. So let me move on to the next slide. So here's the same math, but with no numbers. And what we're going to do now is have Zach actually walk through a live example so that you can maybe get a better understanding of this. All right, Zach, I'm stop sharing here.
All right. Hey, Dan, do you mind sending out the worksheet? Because I think we'll go through this, and the goal is to do this together. So we've really simplified what's going on here. When you're drilling down into unit economics, there's a lot more ways to slice and dice this, but we wanted to provide kind of the simplest solution to just give you guys an idea of what your unit economics look like for your business. And so we'll kind of go through this together. So if you guys can all grab your lists out of your expenses, we'll fill these out together. And we'll give you a little extra time as we go through this. But we'll start with the monthly expenses tab in this workbook. And what we've done is we've just laid out, right now we have 25. You can add rows if you'd like. But what we're doing is we're just going to add our monthly expenses in there. And so I kind of have some examples here of what some monthly expenses might look like for your business. And so I have like a CTO salary, we're paying them $1,000 bucks. A HubSpot monthly subscription, you're paying $40 for. QuickBooks, you're paying $13. Google Suites, $15. The Activate NM monthly membership, you're paying $100 bucks. Uber Suggest is like a marketing tool. So we have these monthly expenses in here that we're going to fill out. And so what this does down at the total monthly expenses, this is telling me based on what these costs, you're spending $1,178 per month to keep your business running. And then on the annual expense side, we're going to do a very similar thing. It's just going to be any expenses that are occur on an annual basis. So for my business, I pay one annual fee per year for website hosting of $624. And then I'm a member of the Hispano Chamber of Commerce, and I pay $325 for that. So on an annual basis, I'm spending $949 annually. So when I pop back here, what we're looking at is that on a monthly basis, if I have just one transaction and my revenue per transaction is $20, you can see that what I make is $20 a month. But my expenses far exceed, both my monthly and annual expenses far exceed that amount. So if in this scenario, I would be losing $1,200 each month in total when we're looking at the total bucket. But when we come down, and this is the unit economics view, when we come down, it's the exact same thing because I only have one transaction. But let's say I was able to do 100 of these transactions at $20 per month. You can see my revenue for the month stays at jumps up to 2,000 while my expenses stay the same. So now I'm making money. But on a unit basis, my revenue is at $20. My monthly expenses make up $11.78 out of that. So I'm now taking out $11.78 of that $20 for all those 100 sales I'm making to cover my monthly expenses. And then my annual expenses drop to only 79 cents per transaction. So what that's telling me is now I'm making $7.43 for every time someone pays this $20 per month. Does that make sense? David, do you want to add anything to that if I wasn't clear?
Yeah, I would. Just wanted to point out that in this example, we're putting all expenses in one big bucket, right? We're not making that distinction that we talked about earlier between cost of goods sold and all the rest of expenses. This is really focusing on profitability, you know? So I just wanted to highlight that difference between the numbers that we talked about previously.
Hey, David and Zach, before we proceed, we have a question from Ron. It says, once you're allocating indirect costs, aren't you getting to net operating margin, not gross margin?
Yeah, and that's what David was saying.
Yeah, this is all treating everything all in one bucket to think about profitability.
Okay.
If I understand the question correctly.
Yes.
Any other questions? Because I think that what we want to do next is have everybody just try their hand. It doesn't have to be perfect, but to start thinking about some of their monthly and their annual costs so that we can think about profitability for your business. But I would love to open up with questions before we do that. Rick, you see any?
So the one other thing I'll say, if anyone's typing in their questions, is this is a very simple model, right? Like for my business specifically, I have 3 different packages that I sell, right? So from $399 a month to $799 a month. And so this model doesn't do a great job capturing that. But if you kind of want to see something like that, what you can do is, like, I would type in $399 here and I can see what my profitability is. Or I could look at $799 and I could see what my profitability is. Sometimes with those packages, your low-end packages, you might be losing money on it and you might not even know it. So it's good to look at it on a per package basis and boil it and slice and dice it some other ways.
Yeah, another way I approach that, I do a lot of financial modeling and projections. And if I have 3 products and they have 3 separate prices, what I like to do is to say, okay, if I had one incremental sale, what percentage chance would it be product 1, product 2, or product 3? And so I would allocate percentage across those 3 products, and then you multiply their price by the percentage that you allocate to them, and then you wind up with this average sales price, if that makes sense to everybody.
Okay, I don't see any other questions right now, David, so I guess we're just going to have people complete the exercise, correct?
Yeah, so we were going to take a break. People can work on the exercise, go take a quick bio break or grab something to eat. And did we say 10 minutes, Rick, or what did we decide on that?
I think, let's say we'll be back here at 11:35.
Okay.
Okay. And then we'll allocate you to breakout rooms to talk about what you've done. Okay.
Yeah, so as you're doing the exercise, think about, well, first off, does this make sense to you at all, right? And then the second is, what questions do I have after kind of walking through an exercise, all right? So everybody will see you back in a few.
Okay, welcome back, everyone. So at this point, I'll give you a little bit of instruction. Dan is going to put you in breakout rooms where we'd like you to discuss this little activity with each other. Think about whether it makes sense to you, and if not, talk about what questions you might have to David and Zach when you come back from the breakout rooms. Also, discuss, did you see anything unexpected or surprising when you went through that exercise? Talk about that too. All right. Any questions before we go into this? Or David, would you like to add something?
Nope. I think and just look forward to some more questions after the breakout.
Okay. So take a minute to introduce yourselves to each other if you're not familiar with each other. And we will give this until 11:45. All right.
Sending to breakout rooms.
Yes.
Recording resumed.
Okay. So who'd like to share their experience?
Yeah, how did we do?
And you can unmute yourselves now, I believe. No?
Dan, Adam can't unmute himself.
Adam. All right, Adam, you are unmuted.
And
Great.
chat also.
We had a great session with I was with Becky and Chubb, I think the Grubb is the last name. So the two people, Chapman Grubb, there we are. The two people that are commented on the chat there. So we had a good conversation, and the thing we really benefited was just talking about our businesses. Becky had economic background, so this was sort of low scale, but there's a few things in there that she hadn't focused on in economics, and Mr. Chapman really saw that he got some stuff that he gained from there, one particular insight. And for myself, I started my business with a similar little chart here, and I had a hard time listening just to the talk, and I have it on this small screen here. So I don't know if there's like little details that I should have gotten more from. I just listed all my expenses. Was there something more that I could have put on there that would have been also more insightful?
Yeah, one of the questions we got during the one period was from Becky saying that, do I put all my costs, I already have a sheet that has everything on it. Do I need to break it out into annual or monthly? Really, the reason why you want to do the annual separately is because you have to divide by 12 in order to see what the monthly impact of that one check that you write during the year. And the other thing I will reiterate is there's two things we can do with this simple concept. One is to take all our revenue and all our expenses, right? And then find out what your bottom line profitability is, all right? Now, the second exercise is to just separate those costs directly related to delivering a product or a service to our customer. And that allows us to, we're not getting profitability. We're trying to come up with this number called the gross margin. And that is really critical because when you're pricing your product, when you're looking at a market, you want just one transaction to be profitable, regardless of what your other expenses are, right? So again, you can take all your revenues, all your expenses, then we can say, is this going to be profitable or not? But when you're going to talk to investors, if you are, they're going to want to know how profitable one transaction is, regardless of all the costs. Or another example would be, if I'm a company, I want to buy you, I have my own set of costs. I don't care about your salaries and all that stuff. I want to know how profitable just that sales stream of sales is to my company. Does that make sense? So profitability is an obvious thing that you want to do here, but the less obvious thing and maybe less known thing is to say, what margin am I making for each sale? All right. And so what you have to do there is separate those costs just related to the sale. Does that make sense, Adam? You can nod or say, yeah, kind of. Yeah. And
in my case, I'm a service.
right.
So the point of sale, and I guess that's the only thing I thought I had was that I sell the service and then I have my profit. What is there something that I'm missing?
Yes. Yes.
To me.
Okay. What's missing is you need to look at other services that are similar to you.
Yeah.
If you can, and say, all right, how are they separating those two costs? If you go to Edgar or one of those websites where you can actually see a public company's financials, and if you pull up their income statement, there'll be a little section called cost of revenue or cost of goods sold, and hopefully they'll list out things that they put in there. So if you're like a SaaS company, typically we'll put things like customer support. They'll put in any third-party royalties. They'll put in costs to deliver, like merchant costs. So you might see things like DevOps might be a cost that are being cost of goods, cost of revenues, really, if you're a service. So DevOps, customer support, and then you might have a team called customer success. And that, and in the service business, some people put all those costs in cost of revenue, and others might put some in sales and some in cost of goods. And hopefully you're not going to lose me here. If it's customer success, if people are upselling, you have customer success people who are actually trying to buy more, and they might even have quotas. I want to upsell this set of customers that I'm responsible for. Then those kind of selling costs, would be partitioned out from maybe the other activities they do. So you have to go look at your industry, see if you can find a public company that, or, Google what kind of business you are and income statement, for example, and see if you can see sample income statements and what are they putting in that bucket.
Yeah, that so the margin is caused by all the expenses I have behind the scenes, right? And so I'm comparing it to another company that may also have costs they have somewhere in there. And what's this edgar.com thing, or is it?
That's a place where you can get public company filings with the SEC.
Okay.
But, trying to pick a company that's maybe in your space and just Google them, just Google company plus income statement, or company plus 10Q filings. And if you get one of those, it's going to be this massive 150-page document. And somewhere in that 150 pages, they're going to be the financial statements. Okay. And what you're looking for is the income statement. And I did one, there's a company that does deliveries, and I pulled up Uber Eats, I think. And they listed out, kind of how they break out those costs. So you've got, in order to be able to come up with this magic number called gross margins, gross percentage of sales, whatever, you have to kind of make sure you're using the same costs as your peers in your same industry.
Hey, I'd like to give the other group a chance
Sure.
to share their experience. So who did we have? Kara, TJ, and Carter. Were you in the other group?
I messed up. I thought you guys said to come back at 11:45, so I totally missed the whole thing. I don't know how that happened. I don't know. I apologize.
Okay, so there was actually, I guess we only had one group. Is there anybody else there? Becky or Chap, would you like to share something?
Jason, Carter, and Ken. When Ken has left, they were in a session.
Ken's gone, and I thought I had longer to come back also, so I didn't miss it completely, but.
Well, we can keep plowing forward. I want to, if
Becky wants to say something.
I'm just, can you hear me?
Yeah.
Okay, I was just wondering, David, you talked about a customer success piece, and Chap was trying to explain to me what that meant. But what I'm wondering is, what is an example of those kind of costs that would go into that section, if that makes sense?
Yeah, I think it's, like a SaaS company, there's a business model called SaaS, software as a service. And you can Google software as a service or SaaS plus cost of goods sold. And you'll see some articles where people talk about, here's the industry practice of what cost should be in there and what cost shouldn't be in there. If that makes sense. And then, if you're a manufacturer, you're producing and selling goods, that's pretty common. They have this whole branch of accounting called cost accounting that covers how you allocate those costs from labor and overhead and direct raw materials and all that stuff. And believe me, that's a fun course. That's one of the things I had to do in my training. But so, just Google cost of goods sold and then some other search term that will pull discussion related to your business. All right.
I think
Okay,
Becky,
and one
Franchise.
other.
Franchise will be another good example. What do franchise companies consider as cost of goods? And I'm sure you can find an article and they'll say, well, you need to put this set of costs and that set of costs because that's just how you do it, right?
Okay, one more question that I have is, in my case, I am like a consultant and I will take a job and I work. I mean, I don't have transactions. So it's really a little bit, this model, I would have to adapt it a little bit more to make it work in my situation.
So that's a good point. So let's say I am a SaaS company, but I also do consulting, right? So a SaaS company is going to be highly profitable. It's just a great business model. And the way you allocate costs, if you're looking at a SaaS transaction, is going to be, according to what all people do, okay? But then you do consulting, and let's say for a $1,000 project, you have to pay a contractor $700. So you're only clearing 30%, and so it's a much lower margin. And that's when you might want to kind of like, all right, I'm going to do the math just on the SaaS business, and then I'm going to do the math just on the consulting business. So you're going to have different margins, and when you put it all together, it's going to be a blended rate. And let's say you do a lot of consulting, it pulls down your SaaS overall gross margin. And hopefully I'm not losing everybody, but if you're blending something that's not highly profitable like consulting with something that's really profitable like SaaS, then if you blend them together, then that consulting business pulls down the margin. But if you separate them out and do the math, you can say, no, but look, my SaaS business is at 85%, even though my services business is at 30%. So you would do those two maths separately so you can explain, like, this is what my profit, my gross margin really looks like. Here's the big picture, but here's isolated SaaS, here's isolated service business. And then, in the consulting, in project work or consulting, the obvious cost would be paying contractors to fulfill the contract. So just Google that and see if you can find what other people do as far as separating those costs just related to delivering the product or the service.
If I could bring a quick example to the table of what the benefit of still thinking along these lines and unique economics and gross margin, even for a services business, is when, like many couple in the cohort are services business trying to build out a product to get away from the project-based, margin-based, linear growth type business. And a year on, you should be able to say, actually, the services business is nothing to shake a stick at. We're getting 30% margin on that, versus the product business. We can't figure out a way to get an actual margin based on the cost of goods sold. Or if you're, they're two different types of businesses, really. And but this is a way where you can say apples to apples from a financial story perspective. Why pivoting your company and your staff to the product that's starting to take off makes sense, because you can see the future of the gross margin in that business and the scale and all those other things, versus there's safety, comfort, and not so much risk in services, but you're never generally going to see super high margins on services unless just the supply and demand for the type of consulting you do works out, where you can charge $1 bazillion an hour.
That's what I charge.
David, I suggest that we move along. We're going to stick around here until 12:15.
Okay, I have 3 more slides.
Okay.
And hopefully I don't go from you guys getting it to you guys not getting it after these 3 slides, but I wanted to kind of expand a little bit on this topic. And, obviously we did a really simple model with a fixed budget of $100,000, right? In reality, you've got these fixed costs and there's these variable costs that you might hear accountants talk about. And those are costs that are optional. They come about if you have more volume of sales. So then if you try to do fixed and variable and do this simple math and bring that to the simple math that we've done, I think it becomes really confusing. But the point I wanted to make is, so we've just isolated one transaction, but a business is way more complicated than that. As you know, one of the pieces that's missing is a timeline, okay? So you need to overlay these concepts over snapshots of time in the future. And that's when Excel comes into the picture. That's when you can't calculate this simply with a calculator. You need something a little bit with more horsepower like Excel to be able to say, okay, let me lay out all my data over the next 3 years. And then you can start, like if I had to have 12 months of data and the costs are rising, but then the sales are rising, you can go take a snapshot at the end of that year that you projected, and then you can just divide and get averages, if that makes sense. So the next step in this journey, either you or one of your co-founders, is to kind of take this concept and overlay it on a timeline with Excel and project out into this wonderful future so that you can get a sense of, all right, I'm not profitable now, but when am I going to be profitable? Okay. So that's one point I wanted to make. I'm going to move forward unless, Zach, you have any comments to that?
Oh.
Good. All right. The other thing I wanted to mention is if you're going to go get venture funding from angels or even friends and family or VCs, you've got to understand this concept of what am I worth? And I took a crash course, was really fun, on business valuation. There's actually an industry where you train and then you get paid for people, a lot of times in a court setting. In a divorce case, what is my business worth, so that you can allocate capital fairly. all it boiled down to for 40 hours really was, what is the expected cash that this business is going to generate? That's it. There's nothing else to it. You hear about market comps and multiples of revenue and all this stuff, but the value of a business is what cash can it generate. And that's it, the end of story. And I was going to hold off on another point, but for a startup, the problem with trying to do what they trained me to do over 40 hours is they rely on 5 years or so of historical data in order to really come up with a projected future that people can buy off on. With startups, you have no history. So all of a sudden the math does not work. And I kind of chuckle when people go to the trouble to do the weighted average cost of capital, and they do all these fancy projections, and they do market comps with Google, which is kind of crazy. And then they try to back into present day and say, I'm worth this. I mean, that's a fun exercise, but in reality, as a startup, what your value is what people will tell you your value is. And I've always, in all the startups I've done, I first go talk to the corporate attorneys, and I would have, I was in Austin for most of my career, and they do transactions left and right and center. So they kind of had a sense of, yeah, that type of business at this stage, yeah, you're worth $2 million. So I thought that was a really relevant number. And then, you can ask accountants, you can ask advisors, but ultimately it's going to be the investor who says, you say you're worth $2 million, and they're going to say whether, yeah, that sounds right or not. So anyways, it's kind of a tangent, but I thought it's an important topic given that you guys are startups. The other thing about this idea that it's all about cash, in today's world, all of a sudden spending has stopped. Millions of people have lost their jobs. So those wonderful cash projections that all these companies had developed, and they deliver that to Wall Street so that Wall Street and investors can come up with, what's this worth to me? If cash is that driver of value and all of a sudden it's gone, then you would expect the valuations have tanked. So what that means to you is, I have had a comment from a local VC, but I've heard other VCs talk about it, is especially in places like Austin or the coast, but startup valuations have just gotten out of control. There was so much money chasing all the deals that it became a seller's market. And if you had nothing, no product market fit, no proof that you had a product market fit, no sales, people are going out and saying, yeah, I'm worth $10 million because it's such a big opportunity. Well, that's going to be harder to do today. And so this concept of bootstrapping, really understanding, am I making a profit on one sale, just isolating those specific costs, and am I making a profit, or do I foresee making a profit, including all my costs? I think that's where this concept is absolutely critical to understand. In tough times, you got to dig deep and really understand the details. And then the one other thing I'll say, and I'll shut up and let Zach throw in some comments, is pricing is a big component of this. It might not be obvious, but we just said $29.95, right? How did we come up with that? I think the journey for discovering prices is sitting down and thinking about one transaction and what does the customer look like on the other side of that transaction. Really understanding who is that person and what value do they see in what I'm doing. And you're going to find that you have you develop multiple profiles of people. And like, let's say the head of IT at a big corporation is going to look at your value proposition and they're going to assign a kind of a mental price for what they think it's worth. But then maybe you're somebody who's in the trenches in IT and actually is getting all the work done, and you're just, this solves so many problems for you. You can't, I mean, it's just, if I would convince my boss to get this product in here, this tool, I can shave 10 hours off of my workload and be way more productive. So you got two different profiles. The head of IT is like, you know, I look at it from big picture. I don't care about, this is kind of valuable, but it's not that valuable to me personally. But then you've got the person in the trenches that this is super valuable and it delivers. I mean, you pay anything for it, right? So when you're thinking about these single transactions from the point of view of, you know, figuring out your gross margins or figuring out your profitability, it's also time to sit down and think about, okay, one transaction, who's on the other side, what is the value they see, and therefore you can start figuring out what your pricing is. Zach, sorry, I was long-winded.
Yeah, no, I agree with everything you're saying. The last thing I'll say, I know we don't have much time, but we've obviously we've simplified unit economics, and if any of you guys have questions and want to get into more detail, we'd love to talk more, and actually get into the meat and bones and meat and potatoes of your business, because it is a little more complex than we're saying. We just wanted to give you an idea and an overview on how to look at the business. So that's all I have to say.
And the other thing I'll say is I have a talk, Dan, you might have to remind me when my talk is on projections. One of the things I do and love to do is building these financial models. And the first talk I gave to what was ABQID cohort on projections, everybody says that was great, but he didn't give us a model. And I wish he would have. And so over the last, I guess it's been a year, I've built this generic model where you just kind of plug in your numbers and it will generate all the stuff that you need to generate. And the idea of building it is that for the New Mexico startup entrepreneurs, I want to just give it away. It's yours to have. Obviously, I don't give it away to like other consultants and they'll use my model and make money for that. And that, you know, if a company can afford to pay me, that would be great. But, you know, for our startup community, I really feel like this is a way I can give back and just give you a model that I think works. And so I will be talking about that at some point. Dan, you'll have to tell me when.
Thank you, David. Yeah, so for those that are new to our community, we do have a community, a paid community called Activate New Mexico. You can find out more information. It starts by taking our accelerator program. It's a 10-week long program, and David King is one of our financial mentors for that. So we do have you scheduled for June. It's a Wednesday in June. I can't remember exactly the top of my head, but yeah, I'll be following up with you for that.
Okay. If anybody wants the model ahead of time, I've found that it's not useful for me to just give my model to somebody and then expect them to understand how it works. So I kind of want to require that anybody wants it, they have to set up a time for me to walk through and give them a tour. And that's what I'm going to be doing in June. I'll do a tour of the model, explaining the logic and structure and what you need to do to kind of take it over. I think that's super important before you get a copy of the model.
I agree. We're getting close to 12:15, so I just want to check with everyone if there are any additional questions at this point.
There's our email if you want to follow up directly.
All right. Well, Zach and David, thank you very, very much. This was probably enlightening for some of you, and a place to get started with your calculations. So let's hear it from them.